Hi, it's Larry Gaines from PowerCycle Trading, and this is my presentation for the Traders World On-line Expo number 12. Before I get started, I'd like to just put out this disclaimer. This webinar is purely educational only, and any stocks mentioned does not constitute advice and should not be construed as a recommendation. Also, before I get started, please get my free ebook. It's Top 15 Option Trading Strategies. So you just go to my website, powercycletrading.com. Put in your name, email address, and you'll get these 15 strategies right then and there. I'm also having a Traders World special, so I'm going to go through this in more detail at the end of this presentation, but just for now, you'll get any choice of my PowerCycle trading courses. They're valued at $797. You get Option Trading Made Simple. It's a $150 value. Daily Market Power Outlook. This is a membership. You get this for 2 months. It's $198 value. And the PowerCycle Virtual Trading Room, it's our virtual trading room. You'll get 2 months for this membership at $294. So the total retail of this is $1,439, and today, just for this Traders World special, or for the Expo 12, you'll get this whole package at $597. So all you need to do is go to powercycletrading.com/world. So that's .com/world. So we're going to go over today who is PowerCycle Trading. We're going to go over how to capitalize on powerful trend breakouts. My favorite trading tools, which are futures, weekly options, and why. How to get significantly higher returns using less capital. How to let winning trades come to you. And a secret trading weapon that I've been using for many, many years. I've been trading and brokering commodities and financial markets for over 30 years, and I began trading futures in the early 1980s, and over 20 years ago I started trading newly created option contracts on cargoes of crude oil, and I traded millions of barrels of these crude oil option contracts. For over 10 years I managed the International Oil Trading and Marketing Group for Transworld Oil Bermuda, one of the largest oil trading companies in the world. And my group traded billions of dollars worth of oil, foreign exchange, and financial market derivatives. And it was not uncommon for us to trade over $1 billion worth of commodity derivatives each and every day. During my 30 years of professional trading, I learned techniques that were not commonly known or used by individual traders. This led me to develop a simple yet highly accurate price cycle trading system that individual traders can easily learn and use to level the playing field with the Wall Street pros. The PowerCycle trading model gives traders or investors the ability to recognize and capitalize on the beginning of a trend rather than getting in at the end. I founded the virtual trading room for PowerCycle Trading, where individuals could improve their trading skills in a live trading environment, much like the opportunity I had experienced during my professional career. After members asked me to teach them how to trade futures, we grew into a more comprehensive trading service, hence the new name PowerCycle Trading, which we started earlier this year. So let's get started on this journey to becoming a successful trader. First, we're going to go through how to capitalize on powerful trend breakouts. And this is one strategy or technique that you can use tomorrow and start using this to improve on your trading and help you spot momentum breakouts and trend breakouts. So at PowerCycle Trading, we incorporate moving averages and trend lines for breakout trades and trade management. One of the biggest things that we will do for breakout trades, we will use trendline breakouts. This is a very simple strategy when used correctly. Trend lines are basically supply and demand of a market. So you have the supply demand, which dictates price movement and the use of a trend line. Trend lines are universally used, but the construction of them can be very dissimilar from one person to the next, causing for very subjective interpretation. The difficulty when creating these lines involves the specific points to select and connect. Human nature often interferes in the proper construction of these lines. We are accustomed to review the historical price activity of a market past to present, with the dates reading from left to right. And as a result, the demand and supply lines of a trend line are drawn and extended from the left side of your chart to the right. Intuitively, this is incorrect. Recent price activity is more significant than historical movement, so precision and accuracy demand that the lines be extended from right to left, with the most recent date appearing at the right side of your chart. So I'm going to go through a lot of examples to illustrate this. First off, the supply trend line is the declining price movement as defined by a downsloping supply line, as well as the pattern of both lower price highs and lows. The supply pivot point is when there is a price high that is not exceeded by the prior price or the price immediately after, and this is what we call a pivot high. So this first example is a chart of Apple, 5-minute chart. This strategy or technique of drawing trend lines works on any time frame. So the first illustration here is this is a pivot high 1. So what you want to do is you come in from the right side of your chart, which is the most current price. So we'll come in here, we'll look for the first pivot high right here. You can see this point is higher, this bar is higher than the bar before and higher than the bar after. So I call this pivot high 1. Then you go up, extend up again, going from right to left to find your next point, which is right here. You can see this pivot high is higher than the bar before and higher than the bar after. Then extend your line down and you have a perfectly drawn supply trend line. Now, using our power cycle trading model, these are is an arrow entry right here signaled where our model actually got long and gave us a long entry signal. So when I see a trend line like this and I have a long signal from the power cycle model, it's a fantastic opportunity for big breakout trade to the upside. So you can see when you broke the trend line, you had a huge move to the upside, for great momentum. And this is on a 5-minute time frame. So I'll show you some other time frames. This is a daily, same way to draw it. So you go from your right side of your chart, pivot high right here, higher than the bar before, higher than the one after. Go up to your next pivot high right here. Excuse me, that's wrong. Here's your pivot high. Here's your first pivot high right here, and then your next pivot high there. So pivot high, higher than the bar before, higher than the bar after. Next pivot high here, higher than the bar before and after. And then draw your line down. Again, here is a trading signal that we had from our cycle model. And I saw a trend line here, perfect entry. This was on gold futures on a daily time frame. Here's another example of a 60-minute time frame using Amazon. Here's your pivot high right here. Here's another pivot high, and here's a pivot high there. So extend from this point to this point. Draw your trend line down. Here was another entry level for signal for our trading model on the 60-minute time frame. So when I see this trend line and I get a buy signal on our model, it's a great, fantastic uptrend and a powerful movement to the up when you break these trend lines. Here's one more time frame. Here's Apple on a 400 tick. We use the 400 time frame a lot for intraday trading. So here's a pivot high. Here's a pivot high. Extend your trend line down. Again, on our trading model, we got a long here. I saw the trend line. Fantastic move to the upside. So the next thing you want to do is, look at what a demand supply line or demand trend line is. The demand pivot point is the opposite of the supply line or supply pivot point. It's when you have a lower price that is lower than the prior price and the price immediately after. This is called your pivot low. So here's an example, first example here. Again, this is the SPY ETF. Here's a 5-minute time frame. And the first pivot low is right here. So you can see this point is lower than the point or bar before and the bar after. So here's your first pivot low. So again, you're going from the right or most current price down to a more older price. So here's your second pivot low right here. So it's lower than the bar before, lower than the bar after. And this creates your ascending demand trend line. Again, we had a signal here from our cycle model. Great short setup, and then I see a trend line. I'm going to look to trade this and sell it on the break of the trend line. What I'll usually do though is I'll give it a little room. I won't sell it the first breakdown, because a lot of times when you first test support or resistance, you'll get usually a bounce back. So what I usually recommend to my members is that you give it a little room, so let it break the trend line, but look for it to break another low point like right in here, and then look to see if you have any support below it. So you can see here it broke this trend line and there was no other moving averages or anything below it, so I had a great move to the downside. Here's another example of the 400 tick chart, and this is again a pivot low here from the right, most current price, the pivot low here. So you can see this pivot low is lower than the bar before, lower than the bar after, then go down to the next one, lower than the bar before and lower than the bar after. So extend your line up, trend line break down. So here's another example, pivot low, break the trend line, and down we go. So my two favorite trading tools, as I mentioned earlier, are futures and weekly options. I'm going to spend a little bit more time on this presentation using the weekly options, but I'm going to go over the major benefits of the futures as well. The benefits of futures, they have significant tax benefits, which is a whole course in itself. What it's called the 60-40 rule. So you're taxed at 60% capital gains rate and 40% at your ordinary income rate. So that's a really nice tax advantage. You also get lower margin costs, low commissions, very high liquid investment, huge volume, great transparency, near 24-hour trading, great for hedging, and really great for portfolio diversification. And it's lower risk than stocks because you don't have that overnight gap. Since you can trade almost 24 hours, it reduces any kind of gaps that you might have coming into the day or into the open of a stock or ETF. If you're day trading, which we do a lot, you can see how low your margins can be. This is on the ES or the E-mini S&P futures. You can get your margin rate as low as $400 per contract for day trading. And for NQ, which we trade a lot of, you can get it as low as $500. So if you make $40 a contract, on a day trade, that's a 10% return. Or if you make $50, let's say, on a NASDAQ E-mini, that's a 10% return there. So you can see how it really benefits, and you can help this to leverage your trading. We do a lot of weekly options, so I'm going to go in a lot of detail about weekly options in this presentation. Some of their main benefits: they're cheap. Since expiration is within days and often hours, you can purchase at-the-money weeklies for as little as $5 to $10 per contract. And I'm going to go through some examples here a little bit to show you the beauty of this leverage. They have unlimited profit potential. You can make 500, 800, 1,000 or more % return on a very regular basis. And when you contrast this with regular options, there's just no comparison. Weeklies are easily traded. They're securities, and they're high volume, high liquidity on most of these, so they're very easy to get in and out of. And weeklies bring in 333% more low risk income. Since you have 52 times a year to profit from these low risk non-directional and directional income strategies using weekly options, you get 40 more opportunities every year than you would with a regular option. Weeklies are for everyone, not just the pros. Now, options have managed to get a bad reputation over the years despite being used by practically every professional investor out there. And this is because most education offered on options is so difficult and complex that new traders are simply overwhelmed. I use what I call the practical way of trading options to teach our members how to use options. And this approach focuses primarily on the option delta and market timing. Market timing, in my opinion, is the single most important factor in assessing a stock's likely price movement. Traders realize the importance of market timing, but just don't have what they need to get the information quickly and accurately. I kid our members that we have an almost unfair advantage because we have both a high probability trading system and the knowledge of how to use weekly options, giving us a great trading advantage. Now when day trading or swing trading stocks, I like to use weekly options, which offer some really exceptional trading benefits. And one of the main ones is what I call leverage at an extreme low cost. Now I'm just going to show you some trading examples of trades that I've done just to show you the leverage and how it can give you some just fantastic returns on your capital. Now these are trades that I took and that I called out to our trading room, our virtual trading room. Now these are unaudited trading results, and I can't guarantee future performance. And remember, one option contract equals 100 shares. So here's just an overview. This was a really great day. This was on a Friday expiration on November 16th. And you can see here just when you take the total cumulative return of all this, every trade I took that particular day, the cumulative or the total of all those returns added up to be over 238%. The cumulative profit per trade per contract was $8.89, so you had an average per trade of 8.2%. Now this is you can go step by step or trade by trade and see how this adds up, and there's no other type of investment where you can do this. So just for example, here you can see bought the 520 calls in November, paid $420 a contract, sold at $5.25 a few minutes later, made $105 a contract. That's over 25% return. So if you take your $105 profit divided by your cost, $420, that's a 25% return. Now remember, this one option contract equals 100 shares, so $4.2 per contract equates to $420. So you can just see the different trades here and what they made. Here's another $100 trade I made. That was the November again 520 calls. These are all day trades. Paid $495 for one contract. Sold a few minutes later for $595. Made $100. So adding all that up, fantastic return. Here's another trade day in October. Just to show you, these are all the trades I took, called out. Here's another $120 trade right here. That's over 22%. I paid $535 a contract for it, sold it for $655 a few minutes later, made $120. So, on that particular day, I made 82%. And on October 18th, I just show you another, really stellar day. Most of our days are like this. The trading model that we use is 70 to 75% winning percentage. So it's a great, highly accurate trading model or system that we use for all of our day trades. And so on this day, I made 52% return on my capital. Here's another trade, paid $440 for one option contract of the October 640 puts and sold it at $545. So I just wanted to illustrate how these things can add up to huge returns, so that you'll hear people say I made 10%, 20%, 100%. That it can actually happen. Now here were those trades I just showed you using our model. Here's that one trade that went short. So instead of shorting Apple at $640 a share, I bought the puts, and then I sold the puts back off down here and bought, went neutral, went short, went neutral, went short, went neutral. So using our trading model, and then instead of using the underlying stock shares or futures or whatever, we'll use weekly options, and that gives us these fantastic returns on our capital. Other facts: weekly options now account for nearly 12% of the 300 plus million option contracts traded every month. Weeklies are still relatively new contract, but should not be overlooked because they offer huge trading benefits, and if you know how to use them, you'll get tremendous benefits in your favor. For some of the more exciting stocks like Apple and Google, weeklies now make up a whopping 40% of all option volume traded. Weeklies come out now every Thursday and expire the next Friday, 8 days later. So I'm going to go over some of the basic fundamentals of these weeklies to show you the math involved and show you how this leverage really works from a mathematical standpoint. So the value of an option is determined by the time value, implied volatility, times the intrinsic extrinsic value. And then by using weekly options for day trading or swing tradings, we have been able to better utilize their beneficial factors of this being time decay, volatility, and option delta, and creating a forceful triple win type trading formula for us to use. Then by combining this with our directional price cycle and breakout system, we have created a high probability trading methodology that can give us outstanding returns on our trades. So the first thing you need to understand is the time value of an option. And this is a graph to show you time decay. It's a curve. It'll show you how time decay accelerates as you get closer to expiration day. So here, every Thursday you get the new weekly option. So here you start out on Thursday with 100% time, and then each day it decreases by an eighth in value each day. So that's a little bit over 12%. So as you go on, you can see how the time accelerates until it goes to zero. So you need to be able to take advantage of this time decay and let it work in your favor. And if you can do that, this is what creates these big returns on your capital. Here's a numerical approach just to show you a table illustrating the same thing. So on Thursday you had time value of 1. I put these numerical values in here just to illustrate the mathematics involved. And I put the implied volatility here at 300, the intrinsic value at 1. So time value times implied volatility of 300 times intrinsic value gives you a value or a premium on this option of $300. So you can see each day it decreases by an eighth under time value, and you can see keeping the implied volatility the same at 300 and the intrinsic value constant at 1, you can see how even if it doesn't move, it goes down in value each day. So here it goes down to $262. The next day the value decreases by another eighth, so now you're at $225. And even here, when you increase the implied volatility up to 800, your time value is now at 50. It barely increases your premium. So you need to be very careful when you're trading weekly options, and know that if you're going to hold this thing overnight, you're going to get hit by an eighth or 12% overnight on the value of that option. So what we like to do at Power Cycle Trading is usually day trade using the weekly options. So if we buy premium, we're going to get out of that premium the same day, and then we don't have the time value going against us. We have other strategies that we can do. If we want to hold it overnight, we might instead sell the options to take advantage of that time decay. So instead of going long with calls, we might sell puts, and then we get the benefit of time decay as well as the directional benefit from using a short put if the market's going to go up and our directional bias or our system says it's going up, we could short puts or put spreads. So here's another quick example to show you. These are two option tables. The top one is the weekly options, the bottom one is a monthly. So I'm just going to show you the 640 strike right here, and we usually use a delta, an option delta around 50 or 60. So all that means is that for every dollar the underlying security goes up, if you have a delta here of say 0.58 and the Apple shares go up $1, then your option would be in value goes up 58 cents. So 0.58 times every dollar it goes up. So that's how you use your option delta. Just a quick explanation of that. So for this example, we're going to take the 640 strike right here. Apple at the time was trading around $632. So that we could have bought the 640 calls and paid 5. The bid was 5 at 505. So that's $500 at $505. So to buy the 640 strike, that cost me $500. Now if you come down here to the table below, you go to the same strike price of 640 calls. This is a monthly, has the same relative option delta of 0.55. It costs you twice as much, $10.50 bid, $10.60 ask, so that's $1,050 versus buying the weekly 640 strike at 500. Now here's another table just to illustrate this point again. Here's Apple again, and here's the $640 dollar mark. So we're going to say that we bought 100 shares of Apple, and it was trading at the time at $640 a share. So that cost you $64,000. Now Apple will usually run in spurts of $1 to $3 at a time, so it's easy to make $1. So if you'd bought 100 shares, you would have made $100 profit. So your capital was put out was $64,000. You made $100, so that's less than 1%. That's 0.16%. Now instead of buying shares, if you'd bought the weekly options with the 50 delta here, let's say, you bought the 640 calls. That cost you $500. We saw that on that option table, just a minute ago. And so if you made $100 on this $500 call that you paid $500 for, your return is 20%. 100 divided by your cost of capital of $500. So you can see the difference. If you make $100 here, you make 20%. If you make $100 here, you make 0.16%. Now here's the monthly option with 12 days till expiration. This had 5 days on the weekly. If you bought the 640 calls with the same delta of 50, they were going to cost you $1,050. If you made $100 on that, your return is 9.52%. So you can see that your weekly options made 20%, the monthly made 9.52, and if you just bought the shares, you make 0.16. So that's the beauty of using options, and that's the really big beauty of using weekly options. Now I'm going to give you here a trade example, a couple of advantages to using directional strategies. This is what we call the advanced directional strategy, and this is using weekly options. And this is a trade example on Netflix. I'm going to give you 2 examples here to show you how the leverage can work in your favor. So this is just a chart of Netflix. This is a daily chart. And you can see a trend line break here. Here's your pivot high, pivot high. Our signal, our trading model gave us a long. So this is on March 16th. And so we could have gone long here, the shares, at about right here where it broke, about $108 a share. And it went all the way up to 124. Actually, on this day, it went up, to 112. So, we could have made a nice profit buying the shares, but instead, we bought weeklies. So here's the 30-minute time frame. Here's another pivot high, broke the trend line. We had a signal, so we were looking for this. And instead of buying the shares, we bought weeklies. And let me show you the next chart. So here you would have bought, your trend breakout was 108, got all the way up to 111. So that's a $3 move, or if you bought 100 contracts, it's $300. It's not a bad return, but look what you could have done if you'd bought the weeklies. So this particular example is, here is a 10-minute chart of the Netflix, just the shares, and here's a 10-minute chart of the Netflix 110 calls. So you can see here, you could have bought the shares right here at 108, and it went up to close to 112, so a nice $3 move. But instead of buying the shares on this particular day, we were able to get the 110 calls, and those were as low as 11 cents or $11 a contract right here, and they went up to as high as $175 a contract. So if you'd bought the $110 calls, this was on March 16th, for $11 a contract, the calls actually got up to $174 a contract. We closed them out, however, at $127, so our net gain was $127 minus $11. That's $116 per contract. That's over 1,000% return on capital. Now here's one more example. This is Apple. This was back on November 16th, and here we had a trend line breakout. Here's a pivot high. Here's a pivot high. We actually had a trading signal here, and it broke and moved straight up during this day on the 16th. So it moved from $510 right here all the way up to $530. So a $20 move in one day. That's a great return on your capital. But let me show you what would have happened if you'd bought weekly options instead of the shares. So here's Apple 5-minute chart. Here's a trend breakout again. Here's pivot high, broke to the upside, got in at 510, got out, say, at 530. But instead, you bought the 525 calls at this same time when it was breaking out. You could have paid $15 a contract for the $525 calls. They went up to as high as $645 per contract. Here's the chart again. So you can see here 15 cents, that's $15, and went up to $645. And this was the November 16th. This was on option expiration. Now if you'd taken that trade, if you were so fortunate to get into that, those are the 525 calls, they would have cost you $15. If you'd held it through the whole thing and gotten out at that particular high of 645, your net gain was $630 per contract. That's over a 4,200% return. 630 was your profit divided by your cost of 15. So this is just to illustrate that you can make these astronomical, returns. This is not something that happens all the time, but this is to illustrate the point. Now, in summary, the dynamics of these short duration weeklies offer us exceptional trading benefits. They offer us the ability to make money with low risk, low capital requirements, shortened time frame for trading, higher profits, higher return on capital, and many weekly trading opportunities. Now the next thing I'm going to go over are 5 steps to let winning trades come to you. First off, you want to have a plan that governs all of your action. Be disciplined in implementing that plan. Learn to patiently wait for the highest probability trades based on whatever model or methodology you're using or you've chosen to use for your trading. Allow the trades to come to you instead of chasing them. Create structure in your trading with set goals, rules, time frames, work hours, and risk control. Treat your trading as a business and not as a hobby. So these are all simple guidelines, but sometimes the simplest things are most difficult to put into action. If your trading model, rules are clearly defined, making it easier to implement. The power cycle trading model, our rules are based around 4 powerful indicators to signal a price cycle change by identifying a defined price range, price volatility, change in price cycle, change in price cycle momentum. Now this provides us a set guideline to use, which allows the trades to come to us. So whatever model you use, know the guidelines and rules and use them. Now we also use 2 to 4 different time frames for all of our trade setups and triggers. And this is a trade confirming process which allows for non-emotional trading. So the end result of using these 5 elements in your trading is that you make decisions based on the model you're using, not the emotions of fear and greed that often sabotage traders, leading them to overtrade and give back their profits. So one thing, we trade a lot of Apple weekly options, but we started trading futures because it has such a high correlation. So here's the Apple weekly chart you can see, and here's below is the NASDAQ 100 futures NQ. So you can see the tight correlation. So it's a great futures contract for us to trade as well. So the next thing I will go over is my secret trading weapon, and this is the foundation of my trading, and this is what I call top-down market technical analysis. Now this analysis allows traders or investors to analyze the market from the macro big picture all the way down to the short term or intraday. The top-down approach begins at the top, and the first step is to determine the macro big picture trend. And I do this by using the power cycle trading model. Once this new cycle trend is identified, then as an investor or trader, you can plan on how to allocate your capital. If a macro trend is occurring, you would probably want to be more aggressive in buying market dips and holding for greater returns. If a macro downtrend is occurring, you'd want to be less invested with larger cash positions. You would be more defensive with any buying, more short-term in nature and with shorter profit targets and tighter stops. And you might want to be hedging your positions. So these factors can help you develop your trading or business plan or investing plan. So the 5 time frames I use for this analysis, and let me back up 1 minute. I started using this analysis probably 20 years ago, and at that time used based on fundamental. We did not have all the great technical indicators and analysis back then, so we'd use this approach using fundamentals, but I've developed it to use it a lot easier method is just to use my technicals. So the 5 time frames I use are the macro market trend, which I measure by monthly time frame, long-term market trend I measure by weekly, medium-term market trend I measure by daily, intermediate-term market trend is measured by the hourly. This is what we use for our swing trades, and short-term trends for day trades, we use minutes and tick time frames. I'm going to show you quick current trends, and this is based on the 23rd of November to show you the model and what it was showing us just going across the long-term trend, the medium, and the intermediate-term trends. So this is the S&P 500 cash, and this is a weekly time frame, and this is our model in here. You can't see the model, but this is where the model went short. So this was back early October, around October the 15th, and we had a cycle turn to the downside, and you can see here it nailed it pretty close to the top end of the range at around 14.25 in that range, and we got all the way down here and tested down to that 13.45. We're still in a long-term downtrend, but very close to going neutral here. You can see the long-term uptrend started. We had one start June 8th, came right here, and for about 4.5 months it was straight up. So this particular model is great on showing you cycle highs, when the trend is starting to develop, and then when the trend is ending. So you can see back here in July 2011, you had a big move down, and then it went neutral, caught the bottom end of it, then went long on October 7th, 2011, had a move for about 2.5-3 weeks. No, it had a move for about a month, then went neutral, then went long again. So this can help us develop, how do we want to trade? Do we want to just be looking for short setups? Do we want to be more aggressive on, if we do get longs, get out sooner? So it helps you develop your trading plan. Now here's the medium-term time frame. We had, these arrows show the various entries for the model. This is also Fibonacci levels in here. So this is the low from June to the high back in September. You can see we came down here to the 618 retracement. Our system had numerous shorts in here. Here was a short back in middle of October, neutral, got long up here, went short again, neutral, short, neutral, currently long. And here's the intermediate term time frame that we use for swing trades. Really nailed a great swing trade long here on November the 15th, and this came in at around 13. Got into that trade around 13.55, right around 13.55, and had a move all the way up to 13.90, and then the system went short at 13.80, got stopped out here at 13.90, and it's currently long. Here's the NASDAQ 100 NQ. Here's the long-term trend. It went short on the long-term trend about the 5th of October, and just went neutral at the close of this week. So it had a huge move down from 2,800 to getting back out at about 2,600. So a lot of great trading in between, but this shows you the direction's down. So we tend to want to be more aggressive on the shorts and less aggressive on the longs. And here's the NQ medium-term time frame. Had a lot of great short setups here, coming in October, and then it went really sideways here, then short again in November, neutral, short, neutral, and now it's holding long. So this is by combining our trading model with this top-down market analysis, we can develop a trading plan for each and every day, or an investing plan if we're looking at a longer term time frames. So if you'd like to learn more about what we're doing, here's just some feedback. This was Doug in Atlanta. He had an incredible day back in October. He had just started trading, and he used the Power Cycle trading model for trading options on Google, and he was able to make 3 trades that one day. He made $100, $30, and $20. So in that one day, he had a huge return on his capital in less than 10 minutes. And he said options on the open is the best money that I've ever spent in trading. Here's another guy, John, in Nevada. He's one of my older traders. He bought the model, and he's very impressed and was very happy with the methodology. He said it's the most clear-cut and logical for me to understand, and is so universally applicable across all instruments. I could not be more satisfied at this juncture with my membership. And then he came on to restate this, several days later, how pleased he was, and that he was using the model for both the S&P futures for trading regular hours in Globex. So if you'd like to take advantage and learn how we, do our trading using the Power Cycle trading model, you get your choice of any of our Power Cycle trading courses. They're actually $7.97 on our website, and you get option trading made simple. It's a $150 value. The daily market after Power Outlook. This comes out each and every day at the end of after the close. You get that for 2 months free in the package, and our membership to the trading room for 2 months. So everything total combination of the retail prices over $1,200. You get this whole package for just $597, and all you have to do is just go to powercycletrading.com/world. powercycletrading.com/world. Now here's what you'll get. You can have your choice of the Power Cycle Futures Day Trading course. It's a 137-page color course manual with 13 videos. Or if you'd rather have the day trading course, this is what we use for our futures day trading. It's a 190-page color manual, 20 videos. Or if you're more interested in just the swing trading or investing for longer term trades, there's the Power Cycle Trading course, and this is a 64-page color course manual with 17 videos. So you get your choice of one of these courses, then you'll get free Option Trading Made Simple. You get 2 free months to our membership in our virtual trading room, and then you'll get 2 free months in our daily aftermarket Power Outlook. And this is a daily video newsletter available Monday through Friday, giving you the daily market review and outlook for the next day that I put out. So it's a great package, and if you'd like to learn our cycle model, you'll get all the details of it laid out in whatever course that you choose, one of these 3 courses, and then you'll get all the other information together with it. So all this just for $597, and if you'd like to take advantage of it today, just go to powercycletrading.com/world. Now also, if you have any questions, please feel free to email me at support@powercycletrading.com. And thank you very, very much for attending my presentation here today at Expo 12.